Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your national underwriter for Old Capital, Paul Peebles. My co-host today is Michael Becker, Senior Director for Old Capital.
Hey, Paul.
And we're here in Dallas. So we are bankers by trade, and wanted to give everyone just a little bit of what I think is going to be interesting information from Kim Radaker. We'll start that in a second. But some challenges that people come up to us all the time and ask, Paul, or even Mike, how do we buy an apartment building? If we own single-family homes in the past and we want to make the transition into apartments, how do we do it? Are all banks the same? Tell me a little bit of how to structure deals. And I thought we'd turn to Mike and get a little background on how Mike puts together transactions for people that have really no or even limited experience of apartment.
Yeah, Paul, when people out there trying to do their first deal, buy the first apartment complex, one of the biggest issues everyone has is, how do I find my partner, the bank, to give me, 75% of the money to close a deal. And, really, when we're out there helping people close on loans to buy their first deal, it's really, what we have to do is paint the picture for the bank. And we have a weakness in the fact that the client doesn't have any previous multifamily experience. So we have to do things like paint the picture to show that they have, things like a third-party management company in place to run the property for them. So that kind of helps, alleviate some of the risk for the bank. Or some of the other things we do are like take maybe a little bit lower loan to value, or potentially even take some additional collateral until, we get through certain hurdles along the way.
Like a CD or something like that.
Yeah, like a CD when you guys show that you have performed for a certain period of time that they would release it back.
Okay.
One of the other challenges, a lot of first timers aren't out there buying the brand new Class A properties that are selling for $50 million. You're buying a 20-unit property or a 50-unit property, and most of those properties are a little bit older and need some work. So, that's part of what we do is we try to help everyone come in with enough capital within their loan to go in and fix everything that needs to be fixed and really improve the property. And, that's part of what we're going to the banks that, we prove up that we've done an inspection, that we know what's wrong with this property and we have a plan to go in and fix it. And, we're demonstrating to them that we have the right plan in place to get the job done. So then the other thing you allude to, Paul, is, not all banks are created equal. So, it's really about trying to, find the difference between the bank A, bank B, and, some banks only want to do commercial loans and some banks want to do a little bit more consumers. And then in the commercial space, just really finding the bank that has real estate appetite and the ones that really just want to do, apartment lending. So that's really some just general discussion points on that subject there.
Good. So tell us a little bit about our interview with Kim.
So Kim's a really, really great story. She's really achieved quite a bit in a pretty short period of time. Kim is manager of about 700-800 units a day, and she's looking to do more and more. And she first started off by, buying a property that was pretty tough and, had some pretty good challenges along the way and a real good success story. So I think without much further ado, we should start today's interview.
Thanks, Mike. We appreciate it. So today in the Old Capital Podcast, we have Kim Radaker. So Kim currently owns about 688 doors. Just a couple months ago, she owned 765 doors, and she manages about 112 doors. So today, welcome to the Old Capital Podcast, Kim Radaker.
Hi, Paul. Thanks for having me.
No problem. Thanks for coming in. So I'd like for everyone to get to know Kim just a little bit. Kim, can you tell me a little bit about your background?
Sure. Grew up in Chicago and went to the University of Iowa. After that, got a degree in finance.
I will tell you that I went to the University of Iowa too, and Kim was able to graduate in 3 years, where it took me a lot longer than 3 years. So she's a little bit more of a genius, and I was a little slower.
I don't know about all that, Paul, but anyway. So after Iowa, spent a little bit of time in Cleveland, worked with retirement plans,
Okay.
a lot of finance and accounting experience, and then moved down to Texas about 12 years ago.
Okay.
Have twin boys that are 7 years old.
Great.
And work all the time when I'm not with them.
That's right. You're a busy worker. So you own some apartments right now, but tell me a little bit, how did you get into the apartment business? I mean, did you go directly into apartments? Did you own some single families? What was kind of your entrance into apartment ownership?
Well, I just joined kind of an investment club and found out a little bit about investing in real estate because up until that point, all I had owned was just the house that I lived in.
And how long ago was that?
That was 7 years ago.
Okay.
And in the first year of kind of looking into it, took a couple months to kind of get started and figure everything out, and then proceeded to buy, fix up, and refinance 7 houses in a year.
Wow. So what it was the kind of the average sales price of the homes?
I bought them as low as about $60,000 or as much as about $85,000. Once they were fixed up, appraisals anywhere from like $105 to $135.
Okay. And you still have some of those homes?
Right at the moment, I still own all of them. One of them is being listed for sale next week, though.
Okay. So how did you make the transition from having so many homes, including your personal residence, to apartments? What was the reason why you got into apartments?
Well, I guess basically when I started with the single family homes, my boys were only like 6 months old. And so they were in the nice little carriers. You could drag them around to houses that were being rehabbed and they didn't move.
Sure.
But once they got a little more mobile, took a little bit of time off in terms of buying the single family, started researching multifamily a lot, learned a lot, visited other properties, talked to other owners, figured out what we could qualify for. Then later on met my business partner, and his background was in buying and reselling houses out in California primarily, and then a little bit in Texas. And we decided to join forces and renovate apartment complexes, buy them, fix them up, lease them up, and then sell them.
And so tell me who your business partner's name is.
My business partner is Will Crozier.
So Will Crozier and Kim Radaker. So their group is called Exponential Properties.
Exponential Property Group,
All
yes.
right, so I like that name. I'm thinking exponential income, exponential part of life, exponential everything.
Absolutely.
So you guys got together. You learned a little bit about apartments from your investment club. You tagged on to some mentors, I'm going to imagine, that kind of taught you a little bit about the apartment business. From the period of time that you guys came together as a team, put Exponential together, to the period of time that you had your first property, how long was that?
Well, we met and started swapping some real estate stories about a year before we closed on our first property, but we were only actively looking on it for about 3 or 4 months before closing the first property.
And how did you find your first property? And tell me a little bit about that property.
We found it, actually. We were touring a property that we were interested in, and it looked like it probably wasn't the right fit for what we were looking to do. And so asked the broker at the end of the tour, hey, what else do you have? And she told us that she had a short sale that had been kind of pre-worked out to a degree, and that the buyer seemed to have disappeared. And so, hey, go take a look at it. Maybe we can slide you guys in if this doesn't work out. And we drove it, and I don't know, we were probably only about 30 or 40 feet into the parking lot. And Will was like, why aren't you on your phone calling the broker?
Really?
So that one was 77 units in Irving. We bought it. It was 68% occupied.
So it was an out-of-state owner that owned the property, and he had owned it for how long?
I think about 4 or 5 years.
Thought he'd get rich buying a property. He had third-party management of the property.
Third-party management for a while, and then eventually went with his own. And I don't think any of either plan was a particularly good one in that particular case.
And so the name of that property is?
Spanish Chase.
Spanish Chase, 77 doors. You bought it for
$1.38 million.
And how much rehab dollars did you have to put into it?
Well, we started out thinking that we were going to put in about $350,000. And then once we were in the deal, what we found out is we did some kind of key upgrades to certain units and kind of test marketed some things. Hey, if we make it look like this, can we get more rent? And what we found out, it was really easy to get the extra $50 for our higher end upgrade, just a few extra finish outs, nicer doorknobs, ceiling fans, those sorts of things.
So tell me a little bit about what extra nice finish out. What does that really mean in a Class C property?
In a Class C property, the people still want the same thing that everybody else wants in their house in Southlake. They'd like to have
nice
brushed
area.
nickel stuff or oil rub bronze stuff. They would like to have a nicer looking kitchen faucet. They'd like to have flooring that looks nice. Everybody wants to live somewhere nice. So just little things, nicer towel bars than just the cheap, ordinary stuff. We didn't back in the day, but now we all use vinyl plank flooring throughout our entire unit. And it looks really classy, really brings it together. Looks much higher end.
So when you guys took over the property and you started to do some of your rehab to the property, what kind of condition did you find the asset in?
It was pretty sad. There were quite a few air conditioners missing. There was one unit that still had the original green shag carpeting from 1973. It actually kind of looked like sod. I actually thought it was sod when the carpet guys were leaving. It was rolled up in the back of the truck, and I'm like, why on earth did we have sod here? We didn't order any sod. And then I was like, oh, that's the carpeting out of 210. So we ended up spending about $550,000 in rehab on that property instead of the $350 we had planned to, but we were able to increase the rents by at least $50 more than what we thought we were going to be able to by fixing it up.
So you had created a pro forma, right, when you guys bought the property, and were you pleasantly surprised after you had done those rehabs on what type of bang for your buck, the money that you had to spend to do the interior upgrades to what the rents were going to be up?
We were very happy with what happened on that. We were able to find out that really throwing some extra money at it, it did cost more, but especially in terms of the value that it added because of the increased rents, it was well worth the money spent.
Okay. Tell us a little bit of when you structured the transaction at the beginning with the lender, and it was Old Capital that did the financing on the transaction. Do you remember how it was structured and what was included into the loan?
That one was 65% loan to cost. So the bank lent us 65% of our purchase price plus the original rehab budget we had anticipated.
Okay. And I think the 65% was due to the fact that you had never done a multifamily property ownership or management. And then 2, this was a very distressed asset.
Right.
And the regional lender that did the loan, the transaction, wanted to have some additional assurances that you had some additional equity into the transaction, at least your first one.
Sure. And it was a slightly different slightly more difficult lending environment too.
It was.
Getting loans at all about a year before that on a distressed asset just wasn't even possible.
Yeah,
so
we were doing 100% equity into deals. There was no loans really available at that period of time. And so you did, what was the amortization on that transaction?
That was 20-year, I believe.
Probably a 20-year with an interest only for the first 12 months.
It was interest only for the first 12 months.
Rate was 4.5 or whatever.
I don't even think it was that. I think it was 3 something.
Yeah, so it was a pretty good loan with the ability to pay the loan off over a period of with no prepayment penalty, or was there a prepayment penalty?
We did not have the prepayment penalty because we went for the floating rate. If we'd done a fixed rate, there would have been like a 3-2-1
step down
on because it was a 5-year loan, but we went with the floating rate. And got kind of lucky. The Fed announced that they planned on not moving interest rates for the next 2 years, about a day and a half before we had to lock the rate.
And do you remember what year you bought that? What month? What year?
That was August of 2011.
Okay, so about three
over 3 years ago.
3 years ago. So
just over 3 years ago.
You fix the property up, you rehab the property, you put dollars into the interiors, the exteriors of the property, and tell me a little bit about what was the disposition of the property. What did you guys do with it?
We actually sold it to some other investors that were acquaintances of ours.
Okay.
And sold it for just over $3 million.
Wow. So you guys had a capital gain of almost $900,000?
Yeah, it was about $970,000. 130%.
130% rate of return. Past performance is no indication of future, but that was a good thing because you had done such a good job that you had taken a value-added property, kind of a Humpty Dumpty property, and kind of put it back together again. What was interesting about the people who bought that property, because it's got to kind of be a win-win scenario, that they weren't looking to buy a value-added property. They were looking to get a yield on their money, so they wanted a stabilized property. And Kim and Will had done such a good job that property was able to qualify for a Fannie Mae loan. And I think they had gotten either a 75 or 80% non-recourse Fannie Mae transaction. So that was great that you guys were able to put the property back together again. The new buyers were able to get non-recourse financing. So let's go to you took the money, you did an exchange into another property?
Right. We had owned Spanish Chase for 15 months, and we then did a 1031 exchange with the proceeds from the sale of Spanish Chase and bought property then what's known as Family Tree.
Family Tree. Tell us a little bit about how you found Family Tree. And where's that property located at? It's
in Dallas near 635 and 75. And we were actually looking at a property next door that we were interested in. And somebody said, hey, I might want to look at the one right next door to the one you're looking at because you can get it even cheaper. That somebody was Paul.
Oh, that's right. So
I don't know if I'm supposed to plug that or not, but Paul has a good pulse of the market. So, hey, you might want to buy the one next door for less money instead. So we did that.
So the second purchase was a property called Family Tree, 244 doors. You guys acquired that in what month, what year?
December 2012.
December of 2012, acquired the property. It was kind of an interesting story is that they were looking at a property just next door to the subject property. And that property next door, I think it was a stabilized property or fairly stabilized property.
It had higher occupancy, but it was still only about 85 or so. Not quite stabilized, but much better than the 50%.
And what were they asking on a per door basis?
20, 22, 23.
23. And what did you acquire this kind of model match property next door to yours?
Thank you, Paul. That was $14,000 a door.
$14,000. So, there's always reasons and stories behind the reasons of why these properties go for different prices. And this property was listed for sale on the market because the group that had previously owned it was a group of owners out of Canada that had some Canadian SEC or the likelihood of like a SEC out of Canada that were having problems. And they had to liquidate the property or sell the property quickly. And they couldn't really find somebody to make a decision. So when the boiler went out in the property, right before they listed it for sale, what happened to the occupancy of the property?
Dropped even more. Both boilers went out simultaneously, so there was no hot water to the property.
So 244 doors, there was no hot water on the property.
And evidently it took them a while to get their act together and get that fixed. So 30 days, there was no hot water to the property. So pretty much everybody good at that point leaves because they like warm showers.
Yeah, all the bad actors were going to stay, and those are not the ones you want to have on your property. So you guys closed on the property again. Was the sales price? Do you remember on that one?
Sales price on that one was $3.45 million.
3.45. So you stepping up from the 1.314 up to the larger number. How much in rehab dollars?
Again, we did a few extra things, but started out with a plan of $2.35 million in renovation and ended up close to about $2.7 million.
But this was a property that, tell us a little bit about the rehab, because I think that's fairly interesting, because you took a property that was built in what year?
Built in 1979.
1979, and it had a pool on the property. And tell us a little bit about the quality of rehab that you guys did on the property.
When we bought it, it was 50% occupied. Every building was beige. The pool was boring. The grass was more dead than alive, and the interiors had basically not been touched. There were many down units in terms of holes in the wall and other issues. We had one building that needed 100 piers worth of foundation work, and it had a bad water leak that wrecked sheetrock and lots of stuff in a good chunk of that building. And so really went in and turned the entire thing around. And so every unit that we've touched, which is now close to 90% of them, have gotten new bathtubs, new tile tub surrounds, all new light fixtures, all new flooring, all new faucets, new toilets, new tub valves, new faux wood blinds. The exterior renovations were many of the patios that were failing. So it was pretty incredible watching the GC company. They had guys that would just come. I was trying to figure out how they would fix these patios that were kind of falling and not level anymore. And they just actually rip them off the building, build a new frame, and then would send guys with buckets of concrete up the ladders on their shoulders and rebuild the patio.
So you took the property at 50% occupancy, you rehabbed the property, and I have to say that the pools look like something out of a Class A property. Almost a luxury hotel. I mean, they did.
Yeah, my dad said it looked like a timeshare.
Did a wonderful job. Just the aesthetics, and I think they Kim and Will, their focus was that they really wanted to have the tenant be proud of the place that they lived at. The previous ownership group had put the property into the ground. The area had, which had other apartments in the deal in that area, other brand new owners had come in and put a lot of money in. And so Kim wanted to bring their property up to that level or even nicer so they can get a better quality of tenant. So tell us a little bit about where the occupancy is right now.
Occupancy now, I think we're 95% physical, 97% pre-leased.
Okay. And what's the disposition of the property right now?
It's just been listed for sale.
So, and what's the listing valuation that your broker has told you that they think they can get?
$11 million.
Wow. So again, those numbers are acquisition price was what?
Basically, we're all in, including the loan, for just over $6 million.
With $11 million.
And about $2 million of that's equity.
Okay.
So.
Very nice. Very nice. Okay. So it can be possible to do these type of transactions. I mean, this is a lot of work. I don't think anybody wants to kid anybody. Tell me a little bit about the hours that you've had to spend on that property. Tell me a little bit about your capacity. What do you do? I mean, I know you don't throw sheetrock up on walls, but tell me a little bit about what's your job in this deal?
I'm definitely responsible for all of the financial aspects. I mean, Will and I both work on this way more than what most people consider to be full-time. Neither one of us have outside stuff aside from family, and probably each work, 70, 80 hours a week is not uncommon throughout the course of all of this to get it turned around. We hire the contractors. We run the interior renovation crews until we're now starting to get big enough to actually hire employees to take over some of the functions that we personally used to do. But we've been completely involved from day one on every single thing that needs to get turned around, from hiring new staff, designing stuff, working on the materials that are going to go into the property. And some of those are sourced domestically. And then we actually started importing some of it directly from China to save money and really be able to do these renovations at a costly way.
Two things. Was it difficult for you guys to raise more money on that second deal than it was the first deal, or was it easier to raise more money on the second deal than the first deal?
It was definitely easier on the first deal.
Because you had a little bit of history behind you?
Yeah, the second deal was definitely easier just because we had the history behind us. Fortunately, they weren't very large dollar amounts that we needed on the first one beyond our own capital contribution. Mm-hmm. So that worked pretty well as well. But then on the second one, we had a ton of people that wanted to invest money way more so than what we could accept.
How many investors did you have in the first deal?
First deal, there were 8, including the 2 of us. But the 2 of us owned about 60-some% of it.
Okay. And then in the second deal, how many investors do you have?
We have 11. So we added 3 new investors and a little bit of additional capital from 2 of the existing investors.
Okay. So, and this is where the story turns out for point number 2. Point number 2 is you guys put a ton of money into this property for the rehab, the interiors, tub surrounds, the cabinets, the countertops. Tell me a little bit about where you guys go to get your materials. I mean, is it the Home Depot, HD Supply? Is it Lowe's?
All of the above, and a few manufacturers in China.
All right, so this is where the story kind of turns out. So because, based on economies of scale, I don't think you could do this if your property was 40 or 50 or even maybe 100 units. But when you start talking about these larger assets, you're going to need to have a competitive advantage than the person that goes just to the Home Depot or Lowe's to buy countertops or HVACs or wherever. So you guys saw an opportunity and you made it into a business. Tell us a little bit about Exponential in one of the business units you guys run.
One of our businesses is Exponential Property Materials. It really started when we were working on our second property, the 244 unit that has since been renamed Las Brisas. And the big thing was we knew that we were going to do basically almost all the interiors there because it was just an absolute disaster when we bought it. And we were going to need over 200,000 square feet of flooring. And so any amount that you can save when multiplied by 200,000, even if it's just a few cents, starts to really add up. So that was the biggest thing that we were after when we went over. On that project, we imported the vinyl plank flooring and ceramic tile, porcelain tile that we used in the tub surrounds. Also some cabinet pulls. Since then, we've found additional vendors. We now import all of our lighting and ceiling fans, bath hardware, doorknobs, again, cabinet pulls, curved shower rods, basically everything that you need to make a B and C class apartment look gorgeous for not very much money.
Yeah, because you're taking a C property and trying to make it a C plus to a B minus property. That's
right.
And you guys are providing the interiors that, say, the A properties or the A minus properties have, that a lot of people wouldn't think that you could do that at the price point for a B minus or a C plus property, but you guys are doing it.
We are.
I mean, you guys are showing the marketplace is that you can, you're not over improving the property, but you're putting better materials into the property that you're getting direct from China. And so tell us a little bit about, you've set this up as a business because I find it interesting is that you are calling upon other property owners and soliciting business from them to help them take a property that's a C plus to try to make it into a B minus property. Tell us a little bit about this, spending all this time in China.
Well, Will's certainly the better one to talk about a lot of that. I went on the first few trips, but then he actually spent 7 months over there from last fall through the spring, finalizing all the rest of the vendors and filling out our product lines and those sorts of things. Basically, we just started ordering for ourselves, and then we had other owners, and they kept saying, oh, okay, well, can I get some of those too, and can I buy some of this from you? And so it has turned into a really busy business. We've got a full-time employee over at the warehouse now, and he's kept incredibly busy. It's kept Will pretty busy going through inventory very quickly.
So you guys import the same type of materials, or even better than, say, Home Depot or Lowe's. You have them manufactured over in China, shipped over on container ship, transferred by rail, and delivered to your warehouse, where other property owners can go in and buy stuff directly from you at a deeper discount than they probably could for a better, higher quality product than they could at, say, Home Depot or HD Supply or Lowe's. Or
sure.
any
and there's even certain small
distributors.
pieces that we still get domestically, but we order. I mean, there's some things that, we've gotten from Home Depot, but we get in such huge quantities that we can actually resell it at a price that's substantially below the shelf price at the store.
Wow. So now are you doing apartments, but you're also beginning a distribution system within the United States, and I think that's exciting. So tell us right now, the property is up for sale. It just went on the market back. This 244 unit property went on the market last week. And I've seen the marketing piece that they came out with, what I thought was interesting. The marketer that has the property listed for sale uses a drone to shoot pictures of the property to kind of put in perspective for somebody who's looking to acquire this property from out of the state or not familiar with the area. Tell us a little bit about these drones. Aren't they just absolutely amazing, the pictures that these drones take?
It is completely amazing. Yeah, they got us some still shots that are in the brochure and then also made a video. So you get to fly up over the property. You can see all the different buildings and where everything is relative to one another in a way that's really unique.
It's highly unusual. I really do like the marketing when it comes to the drones. It really puts in perspective of where the property is located at, how close to the busy streets, other properties in the area, highways. And you have that kind of that bird's eye look that a lot of listing companies, if they're not doing it now, they should be doing it, because I think it's a wonderful way to present a property. So let's go on to property number 3. Now, property number 3, tell me a little bit more about property number 3. What's the property name?
Regal Commons.
Where's the property located at?
Arlington, Texas.
And how many doors in that one?
444.
So how many years ago did you start this?
We started it just over 3 years ago.
3 years ago, 77. 2 years ago, 244.
Last year,
it's
444.
444. This is like... I see where the name exponential comes from. Are you looking at 800 doors or 850?
Probably not quite that big, but who knows? Maybe we'll get to buy something a little bit newer. I don't know.
Wow. So tell me, in what city is Regal Commons in?
Regal Commons is in Arlington.
Okay.
It's right across the street from the GM plant, right at kind of 360 and Abram.
And so tell me a little bit about the age of the property.
That one's late 60s build. It actually had originally been built with a boiler and chiller system, which is a different, slightly less desirable way of getting heat and cooling. And that has all since been converted quite a bit before our ownership, probably 15, 20 years ago, to all individual ACs and all individual hot water heaters.
Do you remember with the boiler chiller systems, twice during the year, you turn the hot to cold, and then 6 months later you turn the cold to hot? And that is very tough for people that it may look like it's cold outside, but the sun may come out and it's 75 or 90 degrees. So it's
Makes April and October a lot less comfortable.
It's very tough because it's done by chilling pipes underneath these properties. So the previous ownership group who owned it 15, 20 years ago made the economic decision to change it out from the piping to individual HVAC, just like you have in your house. And so, again, why did you like this property?
We just really liked this property because it was a good property. It was a great location. It was actually a well-occupied property, unlike the ones that we bought before, but it just really needed a lot of TLC. It wasn't a bad property. It just hadn't gotten much love lately. The pool area was really boring. there was one particularly old, kind of dilapidated playground. That was kind of it as far as amenities, which is not much on a 444 unit property. The unit interiors were just really old and tired, old carpeting, stick down tile, white walls, brass light fixtures, just sort of that kind of thing. And so we've gone in, replaced tub surrounds where needed, put in all new vinyl plank flooring throughout the entire unit, gone back with a more modern paint scheme, resurfaced countertops, replaced faucets and light fixtures, and are getting fantastic rent premiums for that. Also added a second playground, moved the one that was there and fixed that back up, added a grill and amenity area, kind of turned an old abandoned tennis court into a soccer field, added a dog park.
How many acres is this property?
Oh gosh, I should probably know that off the top of my head, but I don't. It's got to be 20-something acres.
It's like 21 or 22 acres.
Yeah.
It is a big property, and it has streets that go through it that it looks like, city streets, but it's actually private streets.
Private streets.
On the property, and you maintain those too. So the property looks like it's in great condition. It was a stabilized property. And tell us a little bit about financing on that deal.
Financing on that one, we were able to get a Fannie Mae loan. It was actually a really good situation. We were able to include a good portion of our renovation budget and upgrade budget in the loan because we were able to buy right. We got 1 year interest only. So that'll come up here in just a couple months.
Yeah. So you did a 30-year amortization, 10-year term, interest rate ran around the...
Just a low 5.29.
Something like that. 5.29 in that non-recourse interest only for the first 12 months. They were able to throw the rehab dollars into the property, which was great. Big loan. How big is that loan?
$12.26 million.
The thing we didn't talk about is the financing on deal number 2. Do you remember how the structure of that one was?
That one was 70% loan to cost. So we got to include the full renovation budget that we had projected and the purchase price, and 70% of that was financed.
So you went from 65 in the first transaction, 70% the second transaction, right. And now you're at 80%.
And the cool thing on the 70% too was it was because of our track record with that regional bank and having paid them off once that really enabled us to get that. Because anytime you have a renovation budget that's 70% of the purchase price, that is something that makes lenders a little nervous.
Yeah. I mean, the regional bank was very happy with you in the first one. They saw the cycle, the acquisition, rehab, and the sale. They got paid back. That's bankers. We love that. In the second transaction, you acquired the property, you've rehabbed the property, you've gotten the occupancy up. It's ready for sale. It'll probably be another month or two before the property actually closes. So the regional lender will get their money back, and now you'll be on to deal number 4. So tell us a little bit about deal number 4.
We are shopping. We are actively looking for properties. We looked at some this morning and looked at some yesterday, a few last week. Got a couple things set up for next week. So really trying to find the right one. We have a couple things we are very, very interested in. It is a competitive market out there right now, but there's still great opportunities.
What is your box? What are you looking for? Are you looking for how many doors? Stabilized property, value added? I mean, what's really the larger property?
Minimum 200 doors.
Okay.
But hopefully quite a bit larger, so that we can just do one transaction rather than having to buy 2 properties to use the capital available. Neighborhood and area of town, year of construction will depend a little bit too on how many doors that'll be. We are hoping for a late 70s or 80s build. I think that would be fantastic. It's a good target, but certainly we'll go older, certainly we'll go rougher. There's a lot of the things that we're looking at are fairly stabilized and just in need of the interior upgrades and amenity upgrades and things very similar to our last project. But certainly if we found something that was a really big mess like Las Brisas was, we would take that on in a heartbeat. There's just a lot less of those left to do at the moment. There's a lot of people that have come in and fixed stuff up, and so there's not quite as much complete disaster areas left.
Tell us a little bit about, you bought 1, you bought 2, you bought 3, and now you're the prettiest girl at the ball. Are these listing agents all over you to buy properties? And what's that like to have people contacting you all the time to try to buy their property? Because I know probably the biggest thing is that people who have never purchased a property, it's like Rodney Dangerfield. They get no respect until they actually close their first one or even the second one. And now
having closed 3, yes, we get calls from brokers all the time. as soon as we put word out that, we're starting to look for the next one, I think I got calls from 4 different brokers just yesterday alone.
Wow.
So it can be pretty busy, but it's good. It's a great problem to have because they're all bringing us stuff. And that does mean that we're getting to see kind of everything the market has to offer and lots of interesting possibilities.
Go back to the third one here. It was a competitive situation. You guys were looking to buy the property. Is there anything that triggered the seller to say, Kim and Will, we want to do business with you? Was it your price? Did you go hard dollars into the transaction? What do you think captured the flag on that one?
I think probably the biggest thing is the hard dollars day one. Short inspection times, not putting a lot of contingencies on it. We had a lot of confidence in our team and in our models. We did as much due diligence as we possibly could before we were even under contract. So by the time we signed that contract, we knew we were going to move forward, and we had really good confidence in our lenders to make sure that we were going to be able to close it. If they told us that we were going to be able to get it done, we believed that they were going to get it done. And so we felt that we could waive a lot of financing contingencies and go strong into the deal.
And you guys put up how much money hard at the first part?
I think that one was $150,000.
$150,000 day one.
Day one, yeah.
So
but
that's a vote of confidence.
It sort of seems small to us, I guess, because when we bought Family Tree, when we were negotiating that transaction
on deal number two,
the seller said we wanted to put $100,000 hard earnest money up, and the seller said, "Well, anybody will walk away from $100,000. That's not nearly enough. I want $200,000." Since we were doing the 1031 transaction, that was going to leave us awfully cash strapped. So eventually, we ended up at $140,000 hard day one. So actually, given the size of the property shift, we felt pretty good about the $150,000 on that one.
And how many partners do you have in deal number 3?
There's 45 of us.
It's a good sized partnership, but it's a good sized property too.
It is. It's a big property.
So, and you did the PPMs, and
so I guess maybe we each own about 10 doors.
Could be. If you look back to where you were, because you began this journey how many years ago?
3.
If you looked at 4 years ago or even 5 years ago and you were a newbie and looking at you today, give me a sense of what new people that want to get into the business, into what you're doing, what should they be aware of? What should they have a conversation, who they should have a conversation with? What are some of the pitfalls in apartment ownership, and what should they do?
Well, you got to get the right people on your team. You got to get your financing piece figured out. You got to get your management piece figured out. You need to know if you're going to hire third-party management, who you're going to use. If you're going to do it yourself, you need to get your certifications from the apartment association or find some people that are experienced in management. Really learn all of those pieces, because those are things that can trip you up. I think we've actually made things a little bit easier with our materials business on some of the new people now, because instead of some huge catalog, we have one ceiling fan that's like well proven that it works and it's the right thing to go in that type property, and so you don't have to spend quite as much time sourcing materials now.
And there's not a problem with that. Let me just interrupt you for a second. I mean, that's how Ford made all of his money. He gave them any color of car, just as long as it was black. Mm-hmm. And you give the client any type of fan, just as long as it's this type of fan that you provide.
Exactly.
You don't have to have 15 different types of fans to choose 15 different types. But if you can make these properties kind of cookie cutter on the interiors, it makes
it so much simpler too, especially on our rehab crews. Mm-hmm. It takes an hour and a half the first time you install a ceiling fan. Right. Our guys can do it in 30 minutes because they've installed 100 of the exact same ceiling fan.
Right.
And it's important to remember that these residents are seeing just their unit. They're not bored with the faucets because it's in everybody's unit. They only have one. So.
Right. The biggest cost is labor. And if you can get specialization of product for labor, that everybody knows how to do kit number A out of the box and fits every unit, every 2-bedroom unit, every 1-bedroom unit. And that specialization will take a cabinet to be put into the property and countertops to be put in the property from 4 hours down to maybe 2 hours.
Yeah. Makes it a lot faster.
Makes it a lot faster. And so I think that's something that I would think would be important for people.
Absolutely.
Is specialization of your supplies and singleization of the type of materials.
I guess the biggest thing I would say, like I said, we've always done value play. We're looking for large capital gains. We're looking to turn properties around. This is something that we just love to do. I love to take a messy property and make it something pretty. I love to give people a nice place to live where they were living in a mess before. I really enjoy the numbers of it, and I enjoy being around the people and working on it. I like the construction aspects. I really like all the different pieces of it. And if you really like all of those things and you really want to work hard in all of those things, then it's a fantastic business to get into. But make sure that it is something that you love in terms of if you're going to really dig in and try to tackle these, especially value play properties by yourself with your own efforts. Make sure it's something that you love to do because it is a very, very full-time job. It is a lot of hours and I love it. I have a lot of fun with it. But if your goal is to not work at all, I think investing passively and finding somebody to be the active operator for you or finding something more stabilized is probably a better fit. You definitely want to get into this sort of for the long haul. When you start the first property, we made a great return on our first property, but it's still sort of a small property. So you want to make sure that you're going to enjoy it enough and want to do it to stick with the second and third and fourth.
Okay. Not everybody has business partners, but you have a business partner that I think brings a tremendous amount of asset to you as a team. What do you think about business partners? I mean, for you, it's worked out well.
I think it's fantastic. I wouldn't have wanted to go down this road by myself. It just really helps to have somebody else to bounce the ideas off of. We've actually even added a third partner now. He was actually just a passive investor in our third property, and we got into some deeper conversations. He helped with a couple small things and then came to work for us, and then now is one of our partners. So having two of us was fantastic. Having three of us is fantastic. It lets us really kind of separate on certain things, conquer more stuff than we could. It gives us kind of double checks on all the numbers that, hey, okay, this is what I just put together. This is what I want to say. Hey, can you read this email for me before I send it? That collaboration is invaluable. This would be a very difficult job if everybody around you had no idea what you were up to. So it's nice to have at least one or two people that really understand the whole picture of what you're up to.
In management, you guys manage your property for property number 1, property number 2, and now property number 3. That's a little bit unusual because most lenders are going to require you guys to have a third-party property management company. They're giving you a very expensive Mercedes if you're 15, 16 years old, and they want you to make sure that you know how to drive it. And so they kind of want or demand you to put time in with a third-party property management company. But you guys didn't do that. Why is that?
We didn't do that. On our first property, I think the size made it so that it was possible to at least have that conversation, to do it on our own. And then even before we got started, I had 4 years of the single family rental experience, had already taken some classes through the apartment association. Will had been working in real estate for 7 to 10 years, had his realtor's license. So we had a lot of experience around then. Also, my background's all finance and financials, and so that's a huge piece of what's got to get done. So I guess we were able to convince the bank that really with the training that we had, the classes we've been to, the groups that we had, the support network that we had.
Yeah, the bank is the one who makes the decision whether you're going to have a third-party property management company or not, or how long that third-party property management company is going to be there, whether it's going to be for 6 months or for 3 years or forever. They want to make sure that you know what the heck you're doing before they let you kind of take over the reins of the transaction. So I think that's a good point to make. And you are your own property management company, and
we are.
And you've also started to do third-party property management too. Why are you guys doing that?
It actually started mostly just because we had some people that we knew well through our investment group actually have an IRA investment in one of our properties, and they were sort of in a tight spot and needed a third-party management company that was required by the bank, and they hadn't found somebody that was going to work for them. And so we sort of stepped in to help with all of that. And but it's a good win-win. It's enabled us to actually get a little more corporate staff and stuff with the extra revenue that provides, and also helps them meet the requirements of their loan.
Yeah, I saw that as a win-win scenario. The borrower needed help. They had a property management company that had bailed on them kind of at the last moment, and then Kim and Will stepped in and took over the third-party property management. So that was great. Again, we'll kind of finish up here. Kim, is there any other suggestions for people that are looking to buy apartments?
It's a tough market, but it can absolutely be done. So just dig in and work hard. Can
we get your email address of Exponential Properties and also your website?
Okay, our website is EXPPG. That's like Edward X-ray Paul George.com. And on there's links to our materials catalog. There's things about our management, pictures of some of the properties that we've done, pictures of our warehouse, a lot about kind of who we are and our back. And there's links on that site also to email either Will or myself or other members of our team.
Kim, I can't thank you enough. Thanks for coming in today for the Old Capital podcast. We appreciate it. And now back to Mike.
All right. Thanks, Paul.
Hey, Paul, I thought that was a great interview. You know, Kim's really out there making it happen.
She certainly is. And what was interesting is after we finished our podcast, they let me in on a little bit of a secret that they had just issued a letter of intent to buy a $31 million apartment transaction here in Dallas-Fort Worth.
Wow, that's amazing. You know, it just really shows everyone out there what you could do if you really just kind of get focused and set your mind to something in a relatively short period of time. So I would just really want to thank everyone for listening to today's podcast, and please join us next week on the Old Capital Real Estate Investing Podcast. We'll have another great interview. If you guys want to find more information about us, please visit us at oldcapitallending.com, and we'll see you here next week.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.